Welcome back to Accounting Matters. I'm Adam Olsen.
And I'm Nicole Harger.
And today we're getting into a topic that's getting a bit more attention these days, especially with CFOs, boards, and for sure private equity groups, and that's dual track exit processes. What we'll be doing today is unpacking not just what they are, but why they're getting renewed attention in the market, and then what actually each path demands for companies that want to run them.
And the timing on this feels right. The IPO window has been reopening, M&A is active again. But before we get into the market backdrop, let's make sure we're all speaking the same language here. So Adam, when someone says dual track exit, what are we actually talking about? What does that mean?
Yes. So just a level set. I mean, it essentially means to do a dual track is to run an IPO preparation process and a sale or M&A process for the same company at the same time.
Sounds like a lot of work.
It can be, and we'll definitely talk a bit about some of the complexities and the nuances there with doing this. But in essence, both tracks are live in this scenario, right? You've got resources allocated to both, and they're focused on each. But neither is actually the decided outcome, at least not yet for the company. They're still trying to navigate which one is the most viable path. And so essentially, you're keeping both doors open until a defined decision point, and then that forces a commitment to one side or the other. So today, we're going to cover the logic behind a dual track. Like I said, talk a bit about how the current market factors or, the context of the current market is factoring in. And then really what each track demands, like you said, can be a pretty arduous and intense process, and what companies need to do from a preparation standpoint. And then really at the end of the day, like what does this mean for CFOs and their teams for companies that are exploring a potential exit path in the future?
Yeah, and one thing I want to flag before we dive into the weeds here is that, this is a topic where the preparation timeline matters more than pretty much anything else. By the time a company is in an active exit mode, the decisions that determine whether dual track is viable have already largely been made. And so if an exit even feels a little bit distant, this conversation is worth having now. So let's dive in.
All right, let's do it. So let's hit the basics first here. So I think the core logic behind a dual track exit is pretty straightforward. The logic really is that each track in and of itself creates competitive tension that makes the other one stronger. And so what I mean by that is that if a buyer knows you have a credible IPO in development, they can't necessarily anchor their offer too low because there's an alternative that still exists on the table. And then, conversely, if the IPO window softens or like during your roadshow reception to what you were trying to market is weak, you also have a live sales process that you kind of have as a scapegoat to fall back on. So you're not held hostage, in other words, to either path. And I think that distinction is worth making between dual track versus just kind of simply keeping your eyes open to either option here is intentional. So dual track exits are going to be more structured. Like I said, there's going to be true resources allocated. You're going to be actually managing through these processes. And I think it's important to note that both tracks are credible. If you're really leaning into a dual track exit strategy, both are going to be visible to the relevant parties. So people will kind of understand you are exploring this. That's what creates that competitive tension. And then, like I said, there's leverage that comes precisely from that credibility being known, like I said, on both sides.
Yeah, and I think as you mentioned, what gets undersold here is that the two tracks don't just coexist. Like you said, they actually actively strengthen each other. The IPO prep signals to buyers that company's house is in order. They've got clean financials, an audited track record, a documented equity story. And then on the IPO side, having known acquire interest gives underwriters a real transaction benchmark. So each track really creates a floor for the other. Kind of the next question, I guess, for you is who actually uses this method? Is it primarily a private equity playbook?
Yeah, no, I think that's a good question. And it is predominantly, I would say we see this in kind of the private equity ecosystem. And I think there's structural reasons for why it's more common there than not. You've got sponsors, private equity sponsors that are used to managing fund economics, right? So they got limited partner return expectations, they're navigating fund timelines and distribution pressure. They also tend to have the advisor infrastructure in place to really run kind of this dual track process properly. So they've got bankers that they work with who've done this, their legal counsel on hand who can manage the confidentiality and disclosure dynamics of a dual track. They've got management teams that they have confidence in that can execute kind of 2 exit processes with really not losing sight of kind of even the day-to-day business. That's a challenge in and of itself.
Yep.
But I think also even just beyond PE, we are seeing dual track exits coming out in other areas. So another common scenario are corporate carve-outs. They tend to be a natural fit for a dual track exit process as well. So this is kind of when a large company is separating a division and they really kind of need an answer on whether it's more advantageous to kind of go forth as a standalone or as an acquisition. We also see it with kind of growth stage and founder-owned companies. They are also kind of increasingly exploring this framework too. Even when they don't run maybe the full simultaneous process, they're still thinking about potentially a 2-prong exit strategy.
Yes, I think the discipline of preparing as if both paths are live has real value, even for companies that maybe ultimately commit to one path early on. It really kind of forces a high level of rigor around financial infrastructure, the equity narrative, and it just overall makes you a stronger candidate on either path.
Mm-hmm.
So is it true that most dual tracks actually end in M&A rather than an IPO? And can you unpack that a little bit? Because I think that might surprise some of our listeners.
Yeah, no, I think that's an interesting question. And I think if you actually go back and look at the historical pattern kind of on how dual tracks tend to, which direction they tend to point to, I think the historical pattern is clear that the IPO more often than not functions more as a competitive forcing mechanism than as kind of the actual outcome in these scenarios. And I don't think that's a failure of the strategy. I think in most cases, it's the intended outcome. Because if you think about it, like once the S1 is filed in an IPO, right, and the company is in SEC review, buyers out there know that a public offering is on the table for this company, right? It's live, it's real, and there's a defined timeline around that because the SEC is going to be going through the review process, and that's going to be kicking off ultimately a roadshow and then kind of going to a public launch. And I think what that does is it helps create a sense of urgency that a purely private sale doesn't naturally generate on its own. And so when compelling maybe M&A bids come in while that kind of IPO SEC review process is live, boards may tend to take those more certain outcomes like from a true bid from an M&A kind of target versus like relying on the market dependent one of the IPO.
Yeah, so kind of what you're saying is the IPO track is often the tool that produces a better M&A outcome. It's not the end state itself. And that reframe, I think, matters for how finance teams should be thinking about the IPO preparation work. You're building towards credibility and readiness that actually makes the dual track viable. And it strengthens the M&A outcome whether or not you ever actually list. So let's dive into the market backdrop here because the why now, I think, matters. In 2022 and into 2023, the IPO market was effectively closed. Rates moved hard, valuations compressed, and companies building towards exits had to pump the brakes. M&A also slowed simultaneously. Bid-ask spreads widened and deal financing got expensive. So the question is, what has changed since? And I think the answer is there's been a genuine recovery, right? Yep. Equity markets have been constructive. The rate environment has stabilized a little bit. And institutional appetite for new issuances has come back. And the conditions that make a dual track viable are in place in a way that they haven't been in years.
Yeah, I think that's well framed. I think layered on top of that recovery is something specific to the PE world that's driving real urgency. And so if you think about kind of the PE landscape and how PE firms tend to operate, right, they have typical hold periods for their portfolio companies. Generally, you kind of think of this 4 to 6 year kind of target window that you'll hold an investment. But a meaningful number of portfolio companies that should have exited, kind of going back to your 2022, 2023 framing, didn't. And that's largely because the market really wasn't there. And so it was tough to kind of divest those investments there. So heading into 2026, and we saw this in 25 as well, and probably even leaning into 2027, there's a real backlog, right? There's a lot of exit candidates that are past their expected hold period, and sponsors, again, are kind of under that LP pressure to deliver distributions. And so they need to kind of figure out what they're going to do. So improving market conditions plus built up pressure, that's exactly the environment that really kind of activates, I think, dual track as a strategy again, and kind of brings it back into the forefront. And so both paths, if you think about it now, are both viable. Like there's a healthy IPO market, there's healthy M&A, and that wasn't true necessarily, 18 months ago.
Yeah. And so the IPO market that's open today, is that the same one that was open back in 2020 and 2021? I think the answer here is no, but it feels like very different conditions than back when we were all going through COVID. So.
Yeah, no, I think that's right. Another right way to frame that. And I think that distinction matters, right? If you think about 2020 and 2021, which seems like ages ago, they were unusually forgiving times, right? We had near zero kind of rates. I think growth companies were valued more on revenue multiples that assumed that capital was essentially free because rates were so low. And if you think about today, that's no longer happening, right? So that era is over. So today's market is a lot more disciplined. I think investors want to understand profitability, or at least a minimum credible path to it. And the equity story, I think, has to be actually grounded in an actual economic model. It's more than just telling a comparing like total addressable market narrative for a company. And I think also for the finance function, that shift is consequential as well. So just having good US GAAP compliant audited financial statements, I think, are table stakes now, right? They're not a differentiator.
Yep.
Investors want the metrics that demonstrate the quality of the business underneath. They want to understand revenue quality more. They want to understand customer cohort behavior better, working capital efficiencies. If you think about adjusted EBITDA, which is a huge, very important metric that gets scrutinized. And then I think this is where a lot of companies maybe underestimate some of that scrutiny. That's something that the SEC, for example, looks at pretty aggressively, kind of on the non-GAAP metric side. So you're constantly having to, address the question about any adjustments you make to adjusted EBITDA and whether or not they should or should not be included. Are they recurring? Are they a normal part of the business or not? And really, it's not just the SEC who's putting that scrutiny, right? I think on the M&A side, buyers are running a very similar analysis and kind of in their own Q of E process, so their quality of earnings process there. And so they're also challenging different add backs and different metrics. And so you really have to be prepared to kind of defend it from both the IPO and M&A side.
And I think on the M&A side, the buyer universe has also gotten broader and maybe a little bit more creative. So beyond strategics and financial sponsors, you've got continuation vehicles, GP-led secondaries, minority investments. And so structures that allow for partial exits or liquidity without really a full sale. And so you have more flexibility around the exit structure, but that also can create more complexity in actually managing the process. So what does that complexity actually mean for a CFO that's managing all of this real time?
Yeah, I mean, right at the end of the day, more buyers means more work, right?
Right.
Or more types of buyers, I guess, means more work, right? So because often it's going to be different information needs, different diligence timelines you're working around, different deal structures like you're talking about. And all of that could be running in parallel with maybe the IPO track we're talking about, right? So with your registration statement readiness and processes that you're trying to do in the background to that. And so I think this is where that resource complexity of a dual track really becomes real, if you will. Like every finance leader, I think evaluating, trying to take multiple paths and different angles here really needs to think about that resourcing plan pretty explicitly, because it will be challenging. All right, so let's maybe then pivot kind of as we think about kind of the two paths here. So the IPO path and the M&A path. Like let's segue into just talking about the IPO track specifically, if we will. So on the IPO side, right, at the end of the day, it's a registration process at its core, right? So you're getting ready and doing all the legwork and groundwork to get your S1 ready to file with the SEC. You file that with the SEC, you got to go through their standard kind of review cycle or cycles, depending on how arduous that becomes. You move on to you completing your roadshow, you move into pricing, and then ultimately kind of listing on the public markets. And so that S1 becomes the central document, as we all know. It houses the audited financial statements. It's got the description of the business. It walks through all the risk factors, the use of proceeds, et cetera, et cetera.
Yeah. So, hitting on kind of the SEC review front, how long does it typically take for the SEC to do their review? Because I do think people probably consistently underestimate that timeline. Yeah.
And I know we've talked about it on this podcast, I think quite a few times in past episodes about IPO readiness and some of the other things. But yeah, you're right. It's not, it's not a perfunctory process. It's not like them just kind of glancing over and rubber stamping and moving on. So for most companies, the initial review process could take anywhere from 4 to 8 weeks. So we're talking 1 to 2 months, right, of time. From there, you tend to get comment letters, if not rounds of comment letters. And sometimes those could be pretty substantive comments depending on the nature and honestly, a lot of the readiness that kind of goes into some of that front end work rather than the back end. So that could be rounds of responses and revisions that you have to walk through. I think all said and done from kind of the initial filing with the SEC, this doesn't include all the prep and readiness work prior to filing, but just when you're going from filing to when the SEC determines that filing is effective, that process can take anywhere from 3 to 6 months. I think the financial reporting requirements are where a lot of PE-backed companies, I think, most often get surprised as well. In most cases, it's 2 to 3 years of audited financials under US GAAP. You have to have audits done by a PCAOB registered audit firm. So if you're using a non-PCAOB kind of regional auditor today, that could create the need to find a new auditor and have to potentially do some re-audits. And again, that adds more complexity to the timeline. So, there's a lot of things that you have to navigate just to really kind of get to effectiveness here.
So speaking of timelines, I think in general for this, you may be thinking 12 to 18 months overall in total.
Yeah,
from
I think that's pretty common.
Readiness perspective all the way to filing. Where do those months actually go? Like, what are you doing in those 12 to 18 months?
We're doing a lot. And like I said, I would definitely refer people back to some of our deeper IPO readiness conversations we've had. But like for today, I guess I would think about that time kind of going into 2 places. So one is getting all that financial infrastructure, if you will, in order. And then 2, the second kind of big bucket of time is really going to be spent on that SEC review and kind of getting to the effectiveness finish line process. And I think neither of those can be really compressed past a certain floor, regardless of how many people you throw at it, right? 'Cause some of those things you are at the mercy of other people and parties and things like that. And the reality is you can't reasonably, in most cases, manufacture kind of a 3-year audited financial track that clears the SEC and has, all ready to go in 6 months. It's not very common when you think about just all of the moving parts and pieces and uplift and things that need to get done. And I think another scenario here, we mentioned carve-outs earlier in our conversation today, but if you are kind of exploring this IPO path through a kind of a carve-out structure, that adds another layer, right? And again, this is when a business has been operating inside a larger enterprise. you're going to be constructing those historical financial statements for a business that never existed as a standalone, right? So you're going to have to figure out all the cost allocations, and you got all the intercompany stuff to navigate, and you've got shared services, and it all has to be documented and then audited, and you're starting from nothing. And so that in and of itself always takes longer than most people originally estimate.
Yeah. And, internal controls also compound that timeline problem.
Mm-hmm.
SOX readiness is non-negotiable for the IPO track, and it's consistently the widest gap that we see in PE-backed companies for obvious reasons. Emerging growth companies do get some relief from full Section 404 attestation in the early years, but the expectation is that you're building towards compliance from day one as a public company. And so control environment weaknesses that build up over the years of a private operation don't close on a sprint. And so the downstream risk there is significant, right? Material weaknesses identified during or after an IPO are among one of the fastest ways really to damage investor confidence.
Yeah, for sure.
And so compliance is really the underwriting relationship. It stops being a compliance issue and it really becomes a valuation issue.
Yeah, I mean, it can definitely impact pricing and the success of your roadshow and things like that. So yeah, there's a lot on the line for sure. And then I think also post-IPO reality, I think we've talked about this too in the past, like that's almost always gets underweighted as well, right? It's not just getting to that effectiveness date and conducting the IPO itself. You actually then have to operate as a public company moving forward, right? And so you got that quarterly cadence that you really have to embed permanently, and you got all the filings, the 10Ks, the 10Qs, the 8Ks, you got your analyst calls, you've got investor relations you now have to navigate and work with, so there's a lot that has to be, you still carry on and have to and continue to manage post IPO. It more or less, it creates like a new set of obligations that entire finance function has to be ready for. So you need to make sure you have the right size team, the right resources to support that ongoing need. And I think companies that really treat the IPO as a one-time event rather than really being like, hey, this is going to have to be a new operating mode that we have to now implement, or hopefully would have implemented during the readiness portion of the IPO process. But this is an area where I think a lot of companies struggle in year one post-IPO.
Yeah, for sure. Let's pivot, I guess, to the M&A, the sale track side of things. Okay. A sale process is more controlled and confidential than an IPO, and it typically moves faster. The faster can sometimes be relative.
Yeah.
The banker prepares the SIM, which is the confidential information memorandum. The company's pitch document, which tells the business story, the financial history, projections, and really the value creation thesis.
Mm-hmm.
Then you've got your interested parties coming in and signing NDAs. They receive the SIM. And then the process moves to a short list of people who get data room access and management presentations, all before submitting formal bids. So I think maybe a 6 to 9 months from launch to close is more realistic for on the M&A side.
Yeah, and it'll vary by the size of the transaction and things like that, but I think that's pretty common. Yeah, 6-month process for sure.
I guess how different are strategics versus financial sponsors and what they're actually looking for? And then how do they approach diligence?
Yeah, I think that's a good question, right? We're seeing, I think often we kind of see two different types of buyers in kind of the sale M&A track that you would kind of bucket as a strategic buyer versus a financial sponsor. Mm-hmm. And like I said, I think it's important to understand kind of which type you're dealing with, because it might shape how you manage the process a little differently. Right. So strategic acquirers are typically buying more so for capabilities like customer relationships or to like integrate a certain market position. And so often their diligence is a deeper dive into the more commercial and operational fit of the acquired or the target company for the acquisition. Valuations in these cases a lot of times are anchored in what the deal does for their existing business. It's not just the standalone value. And so integration planning here typically starts from day one, of having those serious conversations. Financial sponsors, they're underwriting a return on invested capital, right, over a certain hold period. That's really kind of their thesis. And so diligence often is more heavily focused here, like you would expect on the financial side. So they're looking at quality of earnings, they're looking at revenue durability, working capital dynamics, and really understanding how management can execute on that.
Yep.
And so often a very significant component of this kind of diligence is around management continuity and really understanding how that would function and work. And that's often a very strong negotiating point in a kind of a strategic financial sponsor PE transaction. I think it's also worth flagging that you could have a third dynamic that's become more common, and it's really someone that does both of these things, right?
Yep.
Like they like to get their hands into everything a bit. A lot of times with sector-focused PE funds, they'll often think like operators as much as kind of financial engineers, if you will. And so buying market position and customer relationships within verticals that they know deeply might be an example of that. And so their diligence might look like financial on the surface, but then they're really asking strategic questions underneath it all. So like, is the business competitively differentiated? Are the customer relationships durable that we're investing in? And then on the flip side, large strategics have gotten significantly more financially disciplined, especially post, I would say, 2022. So they're really looking even more at kind of internal rate of return thresholds that look more like PE underwriting, I think, than traditional strategic M&A. So I think it's important just to know, right, like at the end of the day, kind of which of these lenses is more dominant for maybe each buyer in your process, because again, it's going to shape the diligence focus, the types of questions they're going to be asking about, the information you have to gather. It might impact how they value the business, and then ultimately kind of what it looks like post-close if you decide to move forward with one of those buyers.
Yeah, I think PE diligence has certainly gotten materially more rigorous over the years, kind of the era of closing over information gaps because you expected multiple expansion and cheap refinancing. Those days are gone. When you're underwriting returns from operational improvement rather than financial engineering, the quality of what you're buying matters a lot more. QOV reports are now standard on virtually every PE-backed deal of any size. Revenue quality, customer concentration, add back validity, working capital normalization, really all of it. Control diligence has become standard as well. Buyers are pricing control environment risk into bids now, or they're holding it as post LOI renegotiation leverage.
Yeah, which is I think why preparation across both tracks is so interconnected, right? There's no version of this where IPO prep is taken more seriously than M&A data room prep, right? I think it's no one's seeing M&A as the easier path necessarily, right? I think you've got serious buyers and serious investors and parties involved in both tracks. And so I think that's important to distinguish.
Yeah, and I think the working capital negotiation at close is also worth its own kind of moment here for us to talk about. It consistently seems to catch companies off guard. The working capital peg is the agreed normal level of working capital delivered at close, and really defining what normal means. So you're kind of stripping out any seasonality, one-time items, your timing differences. This is kind of really where sellers and buyers may fight. Yeah, for lack of a better word.
Disagree.
Yes. Small definitional differences compound into meaningful cash swings in the post-close adjustment. So companies that haven't done rigorous working capital analysis before LOI are negotiating from a disadvantage at the start.
Yeah, and I think negotiations around some of those disagreements that you kind of highlighted, I think those, whether you like it or not, happen exactly when you don't want it to, when you're hoping that the process will be winding down. It's post LOI, can be in the middle of other kind of definitive agreement negotiations. Your team's pretty worn out. think it's important, and CFOs know this, right? That a deal is not closed just because you have a signed LOI, right? That you've still got a lot of financing contingencies that need to be resolved. You've potentially have regulatory reviews that you have to go through depending on the deal size. And you can also have material adverse change provisions that, you have to sort out between the buyer and under certain conditions. And so I think it's important just to know that like there is still work to be done. Even with an LOI in place, that management team can't lose sight, even though getting to that LOI point a lot had been done to get to that point, right? And so teams have put in a lot of hard work, but this is a critical stage of the transaction. And this is, I think, where strong management teams really have to come and rise and kind of get through this. And this is where, CFOs really have to kind of lead the charge. All right. So now that we've hit, I think, kind of each in isolation, both the IPO track and the M&A sale track, if you will, I think it might be helpful just to quickly put both tracks side by side and kind of just pick out maybe some of the bigger differences that inform, kind of every decision, especially when you're running both, if you will, at the same time. So I think the first, I think, is the most fundamental difference is kind of the certainty question, right? So a signed M&A definitive agreement, right? It's going to give you that purchase price and kind of a defined path to close. On the other front, an IPO is going to be subject to market conditions kind of at the moment of pricing. And so you can be fully prepared on a roadshow and still pull the offering in an IPO scenario, right? If the market happens to have kind of an adverse shift. So all that being said, right? M&A sales side, it gives you that certainty of a known price. IPO, again, you kind of have that risk about pricing sliding, but you also have the upside too, right? So if pricing becomes favorable on the IPO track, that's the gamble you're kind of making, that you could capture some of that upside.
I think that asymmetry explains why most boards kind of tend to take that certain outcome when compelling bid arrives. Confidentiality, like we've kind of touched on, is the other dimension that creates real operational complexity. In M&A, you get to control the information flow between your NDAs and your tiered data room access. It's really kind of a tight circle, if you will. So in an IPO, the S1 is a public document. The moment it files, it's going to have your financial history, the risk factors, business description, and it's going to be visible to the entire world, right? Your competitors, your customers, your employees, and then also the M&A counterparties that you're simultaneously negotiating with. And so sequencing those disclosures actually really, requires real planning from the start.
Yeah. And then I think inside the organization, your IPO prep team and kind of your M&A data room team, probably in most cases, a lot of the same people, but, they often need to operate with different information access. And I don't think that doesn't, happen by accident. I think it takes deliberate design. So again, I think timeline and resource intensity kind of can be some of the major differences between kind of the two tracks like we talked about, right? Like the M&A track typically closes faster. It could be anywhere from 6 to 9 months. Sometimes could be even quicker than that, depending on how well structured the deal is and how negotiations go. But like we talked about, kind of that IPO track requires a more sustained kind of push and preparation over a longer time horizon. And then again, even that time horizon could have a dependency on market timing, which could influence pricing. So that could also delay or accelerate things. So running both with the same team is a bit of a stress because they're kind of navigating two different tracks, but then also two different timelines within those tracks. So I think that's, again, I just want to kind of emphasize that resource demand and challenges, it can be tough. And I think this is where a lot of people tend to pull in outside advisors and support to really help with these processes, because there's just so many competing priorities and people are running really hot and thin, and it can be a pretty stressful time.
Yeah. And so walk me through kind of the collapse decision. So when you go from 2 tracks to 1, because kind of like you said, by the time you reach it, the conditions around you aren't really ideal for clear thinking.
Yeah, I think we've talked about people are exhausted probably by the time you've gotten to where you need to decide like which train are you going to jump on, right? M&A bids may not have been where you hoped, or like we talked about, the market may have shifted. And so that decision doesn't always make itself. I think the quality of that decision and kind of where to collapse, I think it almost falls entirely or depends entirely on how clearly the framework was defined at the beginning when you decided to run this dual track process. And so like, what was the criteria that mattered? What information did you say was necessary to make that decision? Kind of who's in the room to make that call? And I think the best dual track processes plan that decision point explicitly up front. I think the ones that don't tend to make the call and then they rely on exhaustion or pressure and not strategy, may not always get the most optimal outcome. Mm-hmm. And so the CFO is almost always going to be the person, I think, with the clearest real-time view of where each process stands, right? They understand the financial story relative to what was told to buyers, what the control environment actually supports, what the working capital says about the business today. The finance function isn't peripheral to the strategy. It's really what makes kind of that decision on which path to go down the most executable.
So if I'm going to summarize one key theme running through everything that we covered today, it's that dual track works precisely because it doesn't let either path get comfortable. Mm-hmm. The IPO track sharpens the M&A outcome. The M&A track keeps the IPO honest. And so the companies that run this well understood that going in and then also built towards it.
Yeah. And then I think if there's a few things that we'd want, finance leaders to take away from the conversation, I think first up is, and we kind of talked about this in the market context, is the market window for both paths are pretty well open. And we are seeing a very active IPO market and a very active kind of M&A activity going on. So both paths are viable. So this dual track is, you can really dive into it, if you will. And I think the companies, like we've talked about before, that have done that prep work well are in the position to really kind of run this dual track process. And then speaking of preparation, I think that's kind of the second point we probably want to make. And we always harp on this, but preparation really is the hard part, almost easier said than done on a lot of these things, especially once you start to roll your sleeves up and get into some of the project planning and actual work itself. And so, if you really are thinking about that IPO as one of the tracks and you really want to run this dual track, just knowing that the market window and things can shift. And so those aren't always waiting for you to get the house in order. So you definitely need to make sure that you're thinking about that as you're building towards it, and understand that depending on where you sit today, that infrastructure could take several months up to a year or years to get ready. So it's not something that can always come together in a matter of just a few months. And then thirdly, I would say, as we all know, and with the teams that we work with and interact with, but like the finance function really is at the center of all of this, right? They're not on the edge here, right? They're the ones preparing the data rooms and getting the information ready. They're pulling together the management presentations. They're really helping navigate the working capital pegs. And they're the ones that are, probably central to that kind of collapse decision that we talked about, and really trying to decide which of the tracks you will ultimately go forth with when the time comes. And so I think the CFO and finance teams, they're doing a lot of that work, and they're the ones that really determine which is the most credible path. So I think that's an important thing to think about when you are kind of looking at your organization and investing in your organization, just making sure you've got the right team at the seat, or you bring in the help you need.
That was well said. I think this is a great spot to wrap up for today.
Yep.
We hope you found this conversation insightful. Thanks for listening to Accounting Matters. We'll catch you next time.